Welcome to the A Day at DPL podcast. DPL's David Lau and founder of Tiburon, Roame, share insights on industry trends, product innovation, and thoughts on how advisors can deliver pricing models based on client needs.
Hello, this is David Lau, and I'm welcoming Roame to the podcast today. Chip is the founder and managing partner of Tiburon Strategic Advisors and the Tiburon CEO Summits. And Chip is a leading strategic advisor to CEOs and other senior executives and boards of directors in the wealth and investment management and wealth tech markets. And I think the kind of crowning achievement of his career to date is that he recently joined the DPL board. So we're super happy to welcome Chip to the board and the team, and looking forward to the conversation today. So hello, Chip.
Hello, David. And I agree with the crowning achievement. Fine comment.
Chip, you're about as connected into financial services as anybody I know, and you've been doing it for a long time. You kind of came up in the industry as a consultant, spent a little time at Schwab, and then formed Tiburon. If you want to give kind of the 30,000 foot view of your career and how you got to where you are, that'd be terrific.
Yep, sure. 30,000 foot view would be: I grew up in Detroit. I went to college and to business school, MBA from University of Michigan, became a McKinsey consultant out of business school, which means big international consulting firm. I happened to get placed into financial services, and so I did all financial services projects, lived in New York and London and Sydney, Australia, and places like that. And then I joined Schwab. Well, actually, two McKinsey guys had gone to Schwab ahead of me. The concept was this was the booming financial services firm, and you wanted to be part of it. And so I did the same. Worked out great. I spent just 3 years there, but it was a terrific 3 years. And then 20-something years ago, I founded Tiburon, and Tiburon's kind of grown up around me. And Tiburon now has hundreds of members, and we do weekly research calls and semi-annual Tiburon CEO summits and all that. And I sit on 6 or 8 boards of companies, and that's kind of my world. My world's financial services plus the wine industry too. But we'll just talk about financial services today.
Oh, I don't know. I think people would probably tune in more if we were talking about the wine industry. Financial services. So, RIAs, obviously huge, hot area, financial services, growing area. Everybody loves the fee-based model, the wrapped account, managed money, recurring revenue model these days. And what are, some of the macro trends you see going on in the RIA market? And there's some really obvious ones, and maybe some that aren't quite so obvious.
Yep, sure. So I think I think of the RIA industry as part of the broader wealth management industry. It is the fastest growing part of the wealth management industry. But, other parts would be, the wirehouses also evolved their model to managed accounts, and insurance agents have also got into managed accounts. So as you said, everyone loves the managed account concept, right? So wherever you're coming from, you're heading towards managed accounts these days, right? So in the broader wealth management industry, I think the trends are, some things that are changing about consumers. Gen X generation is saving and investing most of the money today. Baby boomers are heading into retirement and are going to liquidate some of their monies. Things like minorities and women emerging as significant investor segments right now. So a lot changing in consumer land. You got a lot changing in the industry's land. So we kind of, as we said, we take managed accounts for given today, but now then enter robo-advisors, enter alternative investments, enter cryptocurrencies, and advisors are getting very focused on being broader wealth managers or holistic financial planners. So that's a big industry shift there. And then lastly, at the advisor level, you're seeing these ginormous firms grow up. So they're focused on, in the RIA space, they're focused on lead generation. They're focused on virtual delivery. They're focused on succession planning, things like that. So at the consumer level, the customer level, at the industry macro trends level, and at the advisor practice level, there's a lot changing right now.
One of those obvious trends is that the consolidation. A lot of RIAs pay a lot of attention to that because you've got these mega firms forming. Every day you're seeing transactions happening. Somebody's gobbling somebody else up. And for the smaller firms, they start wondering, what does this mean for me in the future? And is the small firm going to go away? Is it all going to get rolled up into big mega national firms that look like wirehouses? What do you think is going to happen with firm size throughout the industry?
So first of all, I think by way of numbers, last year there were just under 800 transactions in the wealth management industry. So there's even more than that, by the way, in the insurance agent world and in the TPA world and the real estate agent world. Lots of other industries are rolling up around us, but just narrowly in the wealth industry, just under 800 transactions. So to your point, if it's in the news every day, there's about 200 business days a year. It's in the news 4 times a day, to be clear. So there's about 4 transactions per business day now, right? So the big are certainly getting bigger. So whether you focus on Cap Trust or Edelman or Mariner or Mercer or Creative Planning or Wealth Enhancement Group, or I'm sure I forgot a bunch of important, Allworth. There's so many of them, right? Probably 24, maybe 30 private equity backed RIA aggregators right now, about 30 of them, with private equity money. So they're going to keep buying. No doubt they're going to keep buying. The number of transactions, while it's a lot, is still not that many for the size of the industry. So you do the math of there's 30,000 RIAs out there. If an average RIA has a career of 15, 20, 25 years or whatever, you should be seeing some portion of them retire every year. We're still low on that scale. We're not high on that scale. So I think you'll see more transactions in the future, not fewer, right? So up to about 800 transactions per year. I expect that number to go up. I expect the big firms to get much, much bigger. Tiburon is out there fairly vocally with a prediction that within 5 years, you'll see an RIA firm that has $1 trillion of assets, right? So Edelman Financial Engines would claim they have about 300 billion. Cap Trust you could claim even more, has part of that's retirement plan business. So it's a little different math or whatever. But these are hundreds of billions of dollar firms now, not tens or ones of billions, but hundreds of billions of dollars firms. So some of them will be up in $1 trillion zone in 5 years. On the flip side, to answer your other question, I don't think that means little advisors are gone. I don't think you have to join a big firm. I just think that's kind of false logic when people say, well, because the big are going to get so big, you have to be big. Well, there's no evidence for that fact. That's just a made up comment, So because technology is so good in the industry, it's easy to go, you could use AssetMark or SEI or Orion or InvestNet or whatever, and run a very efficient small practice and make decent money in most parts of the country.
It would seem to me that the small firm probably evolves to starting to outsource more of that asset management, because that's kind of a scale business, managing assets. And, the small firms might start migrating more to that and, focusing more on that, being in front of the client and doing business development and managing, being a financial quarterback or something more akin to that than a real asset manager going forward.
Yeah, I think that's right. I mean, you've seen a generational shift from the original RIAs back in like the late 80s, early 90s. A lot of them were stock and bond pickers. They were investment counselors was their lingo for themselves, right? They believed they were like a private bank trust department. They were managing you a portfolio of stocks and bonds from their David Lau and Chip Roame RIA business, right? And that's how a lot of them started. Today, almost every incremental RIA is picking ETFs and, wrapping them in some way. So then your outsource comment is really one of twofold. You're going to outsource. The question is, are you only outsourcing your technology, or are you also outsourcing your investment management process? But very few RIAs exist today that don't use Black Diamond or Orion or InvestNet or Tamarack or something. So the idea of doing that stuff yourself doesn't much exist anymore. And then the question is, do you still believe you're the great stock picker? Like, there's still a lot of advisors out there that buy Morningstar Principia Pro and go through it and they pick the right mutual funds and ETFs and all. They pride themselves on that. That's fine. There's others that have moved beyond that, because you've also seen the models emerge over the last 5 or 7 years. So BlackRock or whoever will just give you their darn models, because guess what? Their models filled with BlackRock funds. And so therefore it's a good deal for them, right? So lo and behold, I think the model business will push more of these advisors to outsourcing. So effectively they will mostly all outsource.
Having been in the RIA industry for a while now myself, I mean, the other thing I notice, kind of changing is some years ago, a lot of the RIAs were like real entrepreneurs, kind of cowboys going independent. That wasn't such a common thing. And the breed of, RIAs from, 15 years ago, they were characters, many of them. And now it's become such a mainstream thing that, so many financial advisors are just opting for that from the get-go. And I think it's, becoming a little less filled with characters than back in the old days.
Yeah, I think that's right. I also think you have two other things going on that add to your trend. One is that young people these days often work at an RIA firm. They don't start an RIA firm. They go to work there. Now, they may stay there forever and become a partner, and or they may spin themselves out of an RIA and go start their own RIA. So a lot of them are growing up in an entirely different generation now. They didn't grow up at Merrill Lynch or at some, wirehouse or brokerage firm or insurance company. They actually grew up at an RIA and then are stepping out of the RIA. And I think that's super interesting to watch, because those people are doing business the right way right from the beginning. And it's just a choice of, do they want to be the entrepreneur and take the financial risk, or do they want to work at an existing firm?
Yeah, and there's a real career path, for young people within, an RIA, from being a planner and customer facing to managing investments. There's definitely a career path for young people, which may not have existed not so long ago. But as these businesses start to get bigger and scale, there's upward mobility there for the taking at the firm.
I'm on the board of Edelman Financial Engines. I think they're a great example. I mean, they have north of 1,000 employees, right? So you have north of 1,000 employees. There's a lot of career paths in there. That's not a 20-person RIA shop or a 7-person RIA shop where, unless Mr. Jones retires, you have no upward mobility or whatever, right? This is a big company. There's plenty of career paths in there.
And one of the other things that, is talked about a lot, I don't know how much of a trend it is, but talked about a lot, is changes in billing models, relative to RIAs. The kind of the AUM fee has been there forever, hovering right around 1%. There's talk about a lot of people pushing flat fee billing, hourly billing, subscription models, things like that. What do you see from the data?
Yeah, I think the reality is the numbers would say it's still almost all AUM billing today. The hot trends, though, are the other things. And so whether it be hourly or retainers, or I think the one that I think is going to stick is subscription fees, where you pay a fixed amount monthly or quarterly or annually. And I think you have this whole generation of investors that are growing up. I think of it as the Netflix model, right? I mean, I'm just used to Netflix charging my credit card every month, whether it's $11.99 or $13.99. I guess they're raising the pricing. The pricing power is what you have when you get there. It's a beautiful thing. But I think this monthly subscription fee for services is kind of a given. People understand that, whether it's Netflix or whatever it is you're being charged for. And I think those are the models that will stick. So another anecdote, I'm on the board of another company called Facet Wealth, and they bill subscription fees. So they never did have an AUM model. The Edelman Financial Engines bills as a percent of AUM, traditional model. Facet bills as a flat fee. I don't think you're going to see the Edelman Financial Engines change models. They're not incented to go to a flat fee, but you're going to see a bunch of new generation of RIAs grow up billing that way. So whether it's Facet or XY Planning Network or Cheryl Garrett's firm, you're going to see these firms grow up doing that. And that's awesome. But that means the battleship turns very slowly, right? We'll be sitting here 10 years from today. It'll still be 90% AUM, right? It just doesn't change that quick when it's only the new people changing, right? You're not going to get, Merrill Lynch isn't going to reprice all their accounts next week. That's not happening. The subscription fee trend is the trend, but it's going to take a long time to get here.
Yeah, I think that's right. And it's the young, also driven by the clientele. Like you said, the younger generation is used to that subscription model. They're going to grow up where AUM fees haven't been the norm for them from the time they started investing, and I think they'll drive that trend. But it is a long play. Yep,
I would also add that those young people have different needs. And one of the things I think the industry is doing a good job of is actually recognizing that in realizing, for instance, they may have no AUM. Therefore, no one who bills on AUM is interested in them. But if you can bill them a monthly subscription fee or quarterly, whatever it is, subscription fee, and you can help them with their broader financial planning needs, maybe that is, hey, what debt should I pay down? I don't have any AUM to give you, Mr. Advisor, but maybe teaching me that I should pay my credit card debt off first because it has a higher interest rate as opposed to my student loan or whatever. I made that up, but but that's help. Or how I should title my retirement plan, my beneficiary designations, things like that. There's a lot of help you can give to people, helping them save on car insurance and life insurance, and none of that has anything to do with AUM, right? And so an advisor who bills on AUM, why would they take that client? Of course they wouldn't take that client. Client has no AUM, but an advisor who bills on a subscription fee opens up the advice world to a whole new set of clients who need help. They really need help. This is high value help in my mind. So I like it. It's not just an age thing. It's also delivering a pricing model that works for what their needs are. Their needs are not managing their money.
It really broadens what the advice is being given on. A bunch of great examples there. When you're younger, the investments, that might not be as big a deal. Put them in low cost, diversified funds, set it and forget it. You're done. But should I buy a house or should I rent? Some basic fundamental questions that aren't really driven around investments are, truly valuable. And then kind of growing with that relationship, I think is definitely going to be a trend as, people's financial needs change. So relative to technology, you made the comment a little bit earlier, technology for an RIA is a pretty powerful thing. In the time I've been in the industry, I think you've seen a little bit of ebb and flow, where originally it was like your old firm Schwab. If you were an RIA, you got Portfolio Center from Schwab, or you got whatever it was, Veo from TD Ameritrade or something like that. Your technology was probably all in one, provided to you from your custodian. And then you started getting all these point solutions coming out. You got a financial planning system and a rebalancing system, and all these different systems. And then what naturally happens is they don't talk together anymore. So it becomes kind of a pain in the neck. And now I think you're seeing a move back more to integrated and consolidated, not completely, still tons of point solutions, but they all talk together quite a lot. And different approaches with some of the major players, I think, into whether they want to provide an all-in-one solution or they just want to be a terrific place to integrate.
I think that's right. I think what you've seen, and I use the same lingo, single point solutions, is we can now name 14 types of technology that advisors use. So, CRM is a category, or financial planning software is a category. We can name 14 categories of that. At the end of the day, the big three for most advisors, it'd be their CRM, their financial planning, and their managed account platform, however they're managing money, right? Those are the big three technologies, and those definitely need to be integrated. And so you're seeing firms like Orion and InvestNet and InvestCloud and Adapar and Vestmark. I'm probably forgetting 6 of them, but these firms are building complete tech stacks or whatever. And that's a really savvy offering for advisors. But this is how the world works, right? And once they roll up all those, I remember a few years ago, Fidelity bought eMoney, and then InvestNet bought Money Guide Pro. Well, guess what happens then? Some people go innovate new financial planning technology. This America country is a really cool thing. It's as soon as those are gone, that incents some guy to go invent again, or gal to go invent again. So I think it's a great thing. It'll just keep happening. And so the platforms will keep getting bigger, and they'll continue to be single point solutions out there. But again, at the end of the day, the technology. I remember when I got in this industry, technology for independent advisors was literally miserable. It was like scary, sketchy stuff that I'm not sure it worked, right? And you wanted to work at Merrill Lynch or Morgan Stanley because they had a desktop software. It was a fancy thing is what it was, And I think that's reversed itself now. I think there's better technology in the independent channel than there is in the employee channel.
There's probably still a lot more to go relative to other industries. Not all industries, obviously, but many, is not quite as technologically advanced. You don't have as much like AI and, machine learning and things like that going on in financial services, but I think that's not far off. Technology is really going to help the advisor do their job relative to how you handle a customer and how you optimize portfolios, what kind of recommendations you make based on client data and in demographics and things like that.
Yeah, I think we have the beginnings of that, though. Even telephone navigation systems, when you try to call your credit card company or your brokerage firm, that's the beginning of AI and ML working right there. Can they identify your account? Can they figure out what you're calling about? Can they get you to grunt 3 words and get you in the right place quicker than they would without them being involved. So I think you're seeing the beginnings of that, and I think it'll keep coming. I think it's a good thing.
No doubt. So we can talk about our world a little bit at DPL. Being on the board, you're extremely familiar with, with what we're looking to do and the mission. And the thesis I've had from the beginning was around, insurance being an antiquated industry and not kind of keeping up with the, advisory business model and the general trends of financial services, where you're looking at products that don't operate on transactional fees anymore, don't pay commissions, are low cost, transparent. And this has been kind of an industry that's been dying to be disrupted or innovated. What are some of the things you saw relative to insurance, which has gotten you interested in helping us out at DPL?
Yeah, so I guess when I think through financial services industries that can be innovated, I think Schwab and Fidelity and others innovated the mutual fund space, and made third-party funds super available to everyone. I think companies like Envestnet and others innovated in the separately managed account space. I think that was pretty cool. I would say you say insurance. I'd say P&C insurance has done a better job, property and casualty, than has life and health, right? So P&C, at least there are, the AcU quotes and all these lemonades and all these, trying to, help you buy competitively, car insurance or homeowners insurance. So you're seeing some movement there, which is positive to see. In the wealth world, you're seeing, supermarkets of structured products, supermarkets of alternative investments. You see opportunities to invest in, I love some of these companies like Masterworks. You can invest in artwork, or, there's a wine one, there's a whiskey one. These are alternative investments. There's kind of the new kinds of timeshares coming where you actually own the home as opposed to owning time in the home, and and your upscale houses and all that. So there's so many industries that can be innovated. And again, on that list for me would be life insurance and annuities, just an industry that's been begging for innovation for decades, not a year or 2 or 3, but decades right now. And so, in many ways, the industry, my humble opinion, and maybe some will be offended by this, but I think the industry grew up trying to complicate the product for consumers. I'm going to make my annuity better than your annuity by adding this crazy rider, and therefore you can't compare me to the next guy now. I'm better, And I think that's exactly what the industry, that's what consumers don't need. Riders could someday just be a list of options, here's the chassis of the annuity, pick your rider if you want it, and it costs X dollars more, right? That's how you innovate for consumers. So I'm pretty stoked about trying to innovate in the annuity and life space. It just seems like a huge opportunity right now.
And the deeper you get into it, sometimes the more you realize there's work to be done on that innovation side. I do definitely believe, it's been an industry that designs products to be complicated, designs them to be sold and not used. That's one of my things I say all the time. Bring products to market that can be used, not sold. In order to use them, you got to be able to understand them and, simplify them.
I'd be careful not to let the investment people off the hook too quickly, because mutual funds 15, 20 years ago were the exact same garbage, right? There's 9 classes of shares, and you use the R share and I use the L share. And, does the customer ever get the right share? Probably not. And does he get the cheapest share? Of course not. And again, it was all the same crap, until firms like Schwab that tried to innovate and said, we will only sell your cheapest share, right? No matter, you can have 1,000 classes of your mutual fund if you want. The only one we will accept is the cheapest one, right? And that's when innovation starts, that's when the garbage starts falling out, right? So I think that's an awesome thing. And I think that's where you're headed right now at DPL.
Yeah, exactly. And for advisors, who often think of complication, a lot of investment advisors, because they've never been able to bill on annuities, have dismissed them, for a lot of reasons that either aren't true or convenient. But one of them is complication. Products are, somewhat complicated sometimes. Some are completely simple, but so are mutual funds. That's something I point out all the time. Explain to me how your mutual fund return is derived. Right? That's an incredibly complicated formula. I can explain an annuity a lot more easily than I can explain the returns of a given active managed fund.
Right. Completely agree. Yeah.
The other, area we focus on is, not only it's the product pricing, and the product design and simplification, but it's also the distribution model. So the distribution model, to me, again, is designed in the 1950s at some point. It's still primarily sold over a desk, over a kitchen table, face-to-face, one-on-one, salesperson to consumer. And that's also something we try to innovate, is bringing products to advisors who can use products, not sell them, and do it through technology and choice and comparison. So many people have likened what we're doing to the Schwab OneSource, which I know you were there at Schwab in the throes of building that.
Yep, I think that's exactly right. And I think, by the way, distribution is two levels. It's it's the consumer distribution, but it's also the wholesalers to the advisors, right? And both of those add complexity and add cost to the products, right? And so, again, even in the mutual fund industry, it was the same thing, right? It was, companies like American Funds and Franklin Templeton and Putnam and AIM and all these had hundreds of wholesalers running around calling on advisors in the Merrill Lynch office in New York or Chicago or wherever, and taking them to lunch and giving them golf balls and all that. Well, guess who pays for all that crap? The consumer pays for all that crap with the worst product at the end of the day, right? And so you don't really need all of that. At the end of the day, if someone could give you a fancy Excel sheet that just says, hey, here's all the mutual funds, rank them by their return or by their expenses or by the color of their brochure. I don't care what you want to rank them by, but rank them however you want to rank them. And that's what Morningstar did, came along and said, hey, we can simplify all this. And they simplified it to like star ratings and all that stuff. And simplification is a great thing, and it helps consumers, right? You can always find fault with simplification, but it always helps consumers. It is always the consumer's friend. Yes,
and in insurance, they've worked hard to go the other direction, even in the forms of applications, right? The application, making the application difficult, is one of the defenses for the insurance company to keep the assets at the company. Let's make it really hard to apply or move the money. And so that's something we also have our sights on and are working towards improving for the betterment of the consumer.
Yeah. Another good example is mortgages. Like, do you remember when getting a mortgage was a miserable experience, and along came Quicken Loans and a couple others like that just said, hey, we don't need to meet you in person. We can give you an online app. There's only 50 questions that matter, and we're going to ask you and be done with it, kind of thing. And again, that's innovation. That's simplicity. That's what helps consumers. And we should be able to buy investments, buy insurance, get a mortgage. All these things should be doable. I may choose to have an advisor hold my hand and do it. You may choose to do it on your own. But at the end of the day, it should be basically the same technology. It's just a matter of asking the right questions and going through the right process. It should not be complicated.
Yeah, no doubt. You see it, simplified in so many different ways, with technology throughout financial services. Now you look at payment systems, which has been big in terms of loads of innovation. You can buy something from your phone and never really have to give your information. Just use Apple Pay and buy something online. It's got to get to some place close to that for the annuity application to purchase any financial product.
Totally agree. I've just spent a couple months in Spain, and I literally don't think I used currency in 2 months. I literally did not use any currency for 2 months. Like, they just take Apple Pay as a given. They don't understand why you wouldn't use Apple Pay. Similarly, by the way, remember when Square was such a super cool innovation where the lady helping her daughter sell Girl Scout cookies could take your credit card and that little square thing went on top of your phone? That's a super cool innovation, except now Apple is out innovating them. They're going to make that part of an iPhone, right? You don't need to have Square anymore. Now it's a core part of your technology. Again, this is innovation. This is where the world needs to go.
What are some of the other, high-level trends that we haven't touched on yet? One that we talk about with advisors a lot is interest rates. Interest rates and this kind of low interest rate era that we've been in dictates a lot of issues for the client, the retiree in particular. What have you seen happening generally with declining interest rate environment we've been in the last decade plus?
We haven't had any interest rates. They've been near zero for a long time right now. Yeah. But, obviously, it favors the borrower more so than the investor. The savvy strategy would be to take out a lot of debt and invest that money. I think that period is ending right now. So that's what we have behind us. I think in portfolios, a lot of what I saw was higher allocations to equities because the bond portfolio was adding so little value. You would also see the bond portfolio being ultra short, because if it wasn't going to earn any interest rates, why take any damn risk kind of thing? Yeah. So it might be less bonds and shorter duration bonds. I think that's where we've come from. And again, I think I'm not here. I can't call the market. I have no idea. But like everyone else, I assume we're going to see interest rate increases now. And I think this is all going to start changing. We're going to go back the other direction. So super interesting. That means pay off your mortgage now, and don't get caught when your mortgage resets in the next year or two up to a higher rate. I think you'll see bonds come back into portfolios, and has a big impact on annuities.
Yes. Yeah. Annuities, get priced based on, generally 10-year, treasuries or, bonds in that duration. So yeah, when bond rates go up, annuity rates, generally go up as well. So it's a good thing for our, product pricing. And it's a good thing for retirees because we focus a lot on that. And that's one of the things you mentioned we see also, right? Advisors who have clients in much heavier equity allocations than has been traditionally prudent. The retiree going into their golden years with a 70-30, 80-20 portfolio because equities have been performing and interest rates have been low. Part of the place that our products play is helping de-risk that portfolio and bring some needed income in, which investments just can't do at this point.
I think that's right. I agree with you. Yeah.
So for advisors, a big part of our story is not only creating these products, bringing them to market, integrating into your technology, so that just like other businesses, we've talked about before, where used to be held away assets, or you had to go through individual applications on maybe alternatives and things like that. You see businesses like ours who are kind of creating those two-sided marketplaces, integrating into your desktop to make them, these kind of investments and insurance in our case, accessible and integrated. And that to me has been part of the secret sauce that we really needed to solve for here.
Yeah, and I think it'll continue to be the secret sauce. And that I think at the end of the day, advisors are going to simplify their own businesses, and simplifying their own businesses to get everything into the portfolio, right? And so if I can run one portfolio accounting system and download my clients I could have been held away mutual funds back in the day. Then it can be held away annuities, held away life insurance, et cetera. But it should also be their mortgage should be dragged in. And if they want to invest in some wacky artwork fund or some wacky crypto fund, that should be pulled in. At the end of the day, you want to get all this into one portfolio accounting system. That's how you deliver great advice. And embedding to that technology is critical.
Yeah. And everybody, like every advisor in every channel, I think is starting to look more and more alike. Where they're starting to manage money on, like we said, managed accounts. Now even the insurance advisor is leading with financial planning. So everybody's starting to lead with planning. They're going to manage your money based on a fee. It's really just where they're hanging their hat that is kind of the difference.
And I would actually argue that's okay too, because I think at the end of the day, we actually are migrating to the right customer-centric offer, right? And, that is a portfolio approach to managing the client's money, probably, pricing based on AUM, but it could be subscription fees or something like that. But at the end of the day, trying to get your hands around all the client's money, whether you actually manage it yourself or whether you're just importing and putting on the statement so that you're correctly asset allocating. I can't tell you how many advisors for decades here have done asset allocation only of the portion of the money of the client they have. That's literally useless, David. That's useless, because if you don't know what the other money's in, it could be in equities or it could be in, currency, then how the hell do you know what your asset allocation should be? It's just like literally a made up number. Oh, but I'm right on my asset allocation. But it's irrelevant is the only problem, And so I'd love to see the portfolio approach to, you don't have to give me all your money, Mr. Client, but I need to be able to see all your money. I need to be able to put it on a statement together and decide the portion I'm managing needs to be managed in this way because of everything you hold. That's the right consumer outcome in every case. And as firms all do that, I think it's great. And therefore, what you said, at the end of the day, if I choose to be an employee at a wirehouse like Merrill Lynch and you choose to be an independent advisor because you're more entrepreneurial than I, that's fine. That's fine for both of us. There's nothing wrong with us choosing to work differently, choosing to deliver a different value to the client's a little less clear to me, because I think there is a perfect value. The perfect value is the portfolio approach.
That's part of the value proposition we talk to RIA firms about DPL, because every advisor is starting to look like you. It used to be, when I first got in this industry, it was the RIAs were the fiduciaries and they were the ones managing money on fees. And now basically everybody's kind of claiming that in one form or another. I'm managing money on fees. I'm acting in your best interest. That may be technical differences between that and being a fiduciary, but to the consumer, it all sounds the same. And if you're an RIA and you're saying, this is what I do, but I don't do insurance, you've got a negative differentiation, to your firm, and everybody else is trying to do what you do and sound like you sound.
I think actually both are true. I think to some great degree, they do the same thing, to a great degree, right? And then on the marketing, of course they say they do the same thing. Of course they say that, right? So in a customer's or a prospect's eyes, like if you're a prospect looking for a new advisor and maybe you're getting referrals from your friends, or maybe you're on NerdWallet and you have them send you 3 advisors, or however you find the 3 or 4 advisors you're going to shop from, I got to believe they all sound exactly the same to the consumer, right? And they're probably within reason pretty darn similar. So it's time to, differentiate oneself. And your point about you don't want to have a negative differentiator, that's ridiculous. You want to have a bunch of positive differentiators.
This has been really great conversation, Chip. Appreciate you joining me this afternoon. Again, so happy you joined the board and appreciate all your help with the business, and look forward to years to come as we continue to innovate this market that's dying for it.
I agree. I'm glad to be on the DPL board, and I think we are going to hugely innovate in insurance and annuities for the betterment of consumers. So I think it's a good thing. So proud of you. Let's do it.
Absolutely. All right, let's go.
Thanks for listening. You can find this podcast on your favorite app or listen at dplfp.com.